During your lifetime, you may think about what it would be like to own your own business and to depend on no one but yourself to acquire security, wealth, to control your own destiny. My name is William Llop. I'm a certified public accountant and I'm a small business owner. My firm works with small to medium-sized businesses. I prepare financial statements for these businesses, consult, and assist them in making their operation more profitable and in developing tax planning. Many business people I have worked with in starting on the road to their success was established through the development of a financial plan. They then followed the financial plan and compared the results of operation to the plan itself. Other businesses started by waking up one morning and going into business. Maybe it was not quite this abrupt, but some of them did go into business without a plan. Many of these businesses who started without a plan would have set up their operation differently, or some may not have gone into business at all had they consulted a professional in putting together a financial plan. The most successful of these businesses, for instance, a music teacher, consulted a professional and put together a financial plan. Now this music teacher has a chain of music stores and indirectly teaches over 3,000 students. This tape is designed to assist the entrepreneur with a dream who wants to start a new business or wants to buy an existing business or is already in business and wants to prepare a financial plan to become more profitable. For those of you who are not currently in business or who are not familiar with financial statements, a quick editorial. Financial statements consist principally of a balance sheet and an income statement. A balance sheet lists all your assets, your liabilities, and your equity in the business at a particular point in time. An income statement consists of the results of operation over a specific period of time. This period of time is usually from 1 month to 12 months. There are other financial statements which essentially elaborate on the balance sheet and income statement. They include, but are not limited to, a statement of cash flows and a statement of retained earnings. For financial planning purposes, we will be preparing an income statement. Then we will add debt service to change the report to a modified cash flow statement. People ask me what business to go into, what kinds of businesses are more profitable from one business to another, or how can they get the best return on their investment? You should generally stick with what you know. For example, the music teacher I previously mentioned had a dream to build a music center for group and private piano lessons. She started with 10 students in 1975, and by 1992 she had 3,000 students in 3 locations, offering music lessons for most instruments and having several revenue centers, selling sheet music and merchandise, and selling and renting band instruments. We will discuss other companies after you understand, and please, you must understand, the gross profit calculation. In the pamphlet enclosed, you will find the following information: the initial cash outlay worksheet, the total cash requirements worksheet, the modified cash flow statement, the gross profit analysis worksheet, the markup of revenue centers, the operating expense worksheets. There are 3 pages to these worksheets, the debt service amortization schedule, and some examples of some sample companies. To make the learning curve more understandable, I have prepared an actual plan for a sample company. You will also find blank worksheets which will enable you to apply this exercise to your own personal business plan. All you need to do is fill in the numbers for your business idea or for your existing business and then start to make it happen. If you have an idea for a business, dream you've always wanted to fulfill, or a hobby that you love, you can make it a source of income, security, and wealth with good planning. You can control your own destiny in your own business by understanding how good accounting and planning relate to your business idea. Before we start the exercise with the worksheets, let's talk briefly about the type of business structure your business will take. The type of business structure is the form your business will take during the life of the business, a sole proprietorship. This is a form of business in which one person owns all the assets of the business in contrast to a partnership or a corporation. The sole proprietor is the only person liable for all the debts of the business. Simply take your income and expenses to Schedule C of your 1040 tax return. This type of structure is simple and basically effective. As a sole proprietor, you and the business are the same in the eyes of the law. The second type of business structure is a partnership. This is a voluntary contract between two or more persons who place their money, effects, labor, and skill in lawful commerce or business with the understanding that there shall be a proportional sharing of profits and or losses between them. The various items of income and expenses flow through to the individual partners and are reported on their personal tax returns. There are general partners, limited partners, implied partners. The list goes on and on. If you choose a partnership, please make sure that you have a written partnership agreement which states the responsibilities, the financial requirements of each party to the partnership. And finally, the third type of structure is a corporation. This distinct status of a corporation sets its existence apart from that of its shareholders. The corporation's capacity is to have a name of its own, to sue and be sued in its own name, as well as the right to buy, sell, lease, and mortgage property in its own name. There is an election, if you so choose, which allows the profits and losses to flow through to the individual shareholders. This election eliminates corporate income taxes. One reason to incorporate is to isolate the liability of the corporation from the shareholders. Another may be to save on taxes. Whatever the reason may be, if you wish it, as the owner of the business, you may choose to incorporate, and you may choose to be the only shareholder. Our sample company is incorporated. Please consult your CPA and or your lawyer concerning the type of structure you are going to choose. I am now going to outline the steps of setting up a retail store, which is going to sell gifts, cards, paper products, and miscellaneous items. Please go to the filled-in worksheets of the initial cash outlay worksheet. The first category is inventory. This company requires inventory. Your business may not. I have set up the worksheets by revenue centers, a description, and an amount of monies needed for this type of retail store. As the business owner, you will buy gifts at a wholesale cost of $15,000. You will buy cards with a wholesale price of $7,000. You will sell paper products for a cost of $5,000, and you will have some miscellaneous inventory items with a wholesale price of $5,000. The total cash required for inventory is $32,000. You just spent $32,000 on inventory for your new store. On the right margin of the worksheet, you will note that I have calculated the percent of inventory dollar that applies to the category. I will use these calculations later. Your inventory purchases are graphically displayed on this pie chart with 46.9% going to gifts. The internal controls necessary for a retail store are sometimes cumbersome. We have invested a goodly sum of cash in the inventory, so we must take care of the inventory by counting it. When you are preparing a physical inventory at month's end, you may want to tag your inventory when it comes in the door, so you can more easily calculate the purchase price of the item. There are a myriad of ways to track your inventory. One way would be to color code your inventory with a tagging system and prepare physical inventories using the color coding technique. When you prepare physical inventories at month's end, you will communicate this information to your CPA. It can be quite burdensome to prepare inventories at month's end, but it is a task you should go through for accurate planning and results of operation. My recommendation is to numerically track your inventory dollar by category. For example, your financial statements should reflect each inventory category and the dollars associated with each category. When you prepare physical inventory at month's end, you can count it by category. This way, you will have 4 small projects instead of 1 large one. The business has 4 types of inventories, therefore 4 projects. Your business may have 1 to 10 types of inventories or maybe no inventory at all. Track revenue by revenue center. This way you can see what sells. For example, this gift store, we spent $15,000 of our $32,000 on gifts. This is 46.9% of our inventory dollar. We anticipate our gift sales to parallel the same percent as it applies to our total sales dollars. If we sell more cards than gifts, we may want to reduce our inventory to gifts and increase our card inventory to more closely parallel our sales volume. We will elaborate on that later on in the video. When you have certain items that are not selling within the store, you may want to physically move the displays within the store. The reason I have spent a little more time in this area is because of the amount of monies required for a retail store. Some businesses, as I have previously mentioned, do not require inventory or do not require as much inventory. The types of businesses we will be looking at later in the video are construction, which requires little or no inventory, manufacturing, which does require inventory, services, which generally do not require inventory, and retail, which does require inventory. Now let's look at the total cash requirements pie chart. As you can see, of the total cash required for this business, 63.6% goes to inventory. For some other types of businesses, inventory is not required, but the initial cash outlay may require more equipment versus inventory. Machinery and equipment. Now back to the initial cash outlay worksheet. Let's look at machinery and equipment. For the sake of our example, you will require a cash register. This register allows you to capture sales within certain categories or revenue centers. Your categories are gifts, cards, paper products, and miscellaneous items. You will also have separate category which will calculate the sales tax. You're able to find a good used cash register for $500. You will also need a copier machine. You found a good used copier machine for $1,000. You are not frugal in purchasing a used equipment, but you would rather put more items on the shelf than spend a lot of money on equipment. You have also decided to purchase a fax machine and a computer. You have spent $800 and $2,000 for these two pieces of equipment. The total cash outlay for machinery and equipment is $4,300. When I look at the next piece of the total cash requirements pie, I see that 8.6% is for machinery and equipment. The next area of cash outlays is furniture and fixtures. It turns out for this business that your inventory suppliers are providing you with displays. However, you have contracted with a construction company to build a large display case for $1,500. You feel you need this display for your more valuable items. Also, you need some chairs for $300 and 2 folding tables for $150. The total expenditures in this area is $1,950. When you compare this to the total cash required, you find that 3.9% applies to furniture and fixtures. Now back for the final time to the initial cash outlay worksheet. Deposits are the final area. You need to pay the following: rent, $2,000, water, $150, phone, $100, and power, $250. At this time, let's elaborate a bit on the lease of the business location. Be smart. You may be able to negotiate some free rent for a period of time. Also, watch the rent override stipulation in the lease. For some landlords, a flat fee is not enough. They want a certain percentage of your sales when your sales are greater than a certain number. This certain number is sometimes referred to as a break point. Please be careful here and make sure you understand the calculation. 2 more points on the lease of the location. Number 1, this business is incorporated. Among other things, you have created a shield of liability if the store fails. Do not sign personal guarantees for the lease, which most lessors say they require. You may want to give your requirements to a real estate broker. A, no personal guarantees. B, no rent override. And let the broker negotiate the lease. Number 2, for most businesses that deal with the public, location is important. Location, location, location. Have I mentioned location? I have totaled for you the total cash dispersed. As you can see, our initial cash outlay total for this business is $40,750. Congratulations. We have completed the first step in preparing your total cash required for our sample company. I have filled in for you the total cash dispersed of $40,750 from the initial cash outlay worksheet. As you can see from the worksheet, you have more information to fill in. You can see that I have filled in for you the net operating losses. Certainly, you do not go into business with the expectation of losing money. However, most businesses do not generate profits the first month of the operation. These losses come from the modified cash flow statement, but for now, you know that. You have spent $32,000 on inventory, $4,300 on machinery and equipment, $1,950 on furniture and fixtures, and $2,500 on deposits. As you can see from the graph, we have yet to detail the 19% of the total cash requirements or the net operating losses. But let's hold off for now and let's go to the modified cash flow statement. Please follow me along and let's look at the column headers. Here are months 1 through 12, a total for 12 months, and a percent of sales column. This percent of sales column shows you as a percent the amount that applies to the total revenue dollar generated. The row titles are total revenue, which is simply total sales. We have total COGS, which stands for cost of goods sold. That is what we paid for the goods we sold. Total COGS labor, which is the direct labor cost associated with the production of the product. Total COGS material, which is the direct cost of the product sold or produced. And finally, gross profit. You see how easy? You have sales less the cost of goods sold equals the gross profit. The next area of costs are the operating expenses, which consist of salary and related expenses, supply and related expenses, travel, entertainment, and auto. There is a row heading for services, advertising and promotions, occupancy and related costs, and finally, debt service. Then add these 7 line items and call it total operating expenses. Now all you have to do is subtract the operating expenses from the gross profit figure and you get net profit or loss. This is easier than you thought. Now this is a modified cash flow statement, and as I have mentioned earlier, we have included total debt service, which changes our income statement into a modified cash flow statement. Let's look at the percent of sales column, which is the last column on the modified cash flow statement. Now if we sold $100 worth of goods, this is reflected as a percent. The cost would be as follows. 46.41% went to the actual cost of the product. Let's scan down to the total operating expenses. The amount as a percent of sales to the total operating expenses is 52.98%. The large majority of the operating expenses is made up of salary and related expenses of 21.78%, occupancy and related expenses of 15.81%, and debt service of 6.54%. These are pretty large pieces of the pie. Where salary and related expenses make up 21.8% of the sales dollar. You can see on the graph where every incoming dollar is going. You can see how the cost of goods sold material takes up 46.4% of the incoming dollar and how supplies only takes up 2% of the dollar. Please turn to the next worksheet titled the Gross Profit Analysis Worksheet. I have entered for you the following sales figures. Month 1, $6,000. Month 2, $8,000. Month 3, $11,000. Month 4, $12,500. Month 5, $13,500. Now month 6, $16,000. Month 7, $18,000. Month 8, $20,000. Month 9, $21,000. Month 10, $22,500. Month 11, $24,000. And month 12, $23,000. And finally, the total sales of $195,500. When we look at our bar graph, you can see a steady increase in revenue, peaking at month 11 at $24,000 in revenue. We anticipate this sales revenue because, number 1, I'm familiar with this type of business, and number 2, and more importantly, the location is right for this type of business. Have I mentioned location? For instance, there is not a store of this type carrying these type of items in the near vicinity. There is a grocery store in the shopping center in which you are located, which has a large following, so we can expect good visibility. Also, we have received from this shopping center a written guarantee that we will be the only business in the shopping center that will be allowed to carry these particular products. Now, this is a written guarantee. Yes, I promise to pay my rent, but they still want my security deposit. They promise not to let any other business of this type in the shopping center, so they must show their good intent in writing. We have all the utmost faith in mankind in general. However, when they write it down, it sure makes me sleep better. Now, life is good, and let's move on. Whatever your business may be, location is generally important. If we're a construction company, I want to be in a location that has good access to the interstates. If we are in the service area, we want a location that matches the services provided. For instance, a child care facility should have a younger neighborhood to service. If we are retail trade, we probably want an area with discretionary income. Now I've mentioned location. Now let's go back to the financial plan at hand. We have isolated our total sales on a monthly basis. Let's go back and look at the inventory we purchased as indicated on the initial cash outlay worksheet. Of the 100% of inventory, we spent 46.88% on gifts. We spent 21.88% on cards. We spent 15.62% on paper products, and finally 15.62% on miscellaneous items. These are the percentage breakouts we expect the revenue centers to generate. So let's go through the calculations and observe the breakout of revenue. Now back to the gross profit analysis worksheet. We simply multiply the 46.88% for gifts times the total sales and get the monthly breakdown. For instance, I take sales in month 1 of $6,000 times 46.88%, and you get revenue from gifts of $28.13. The second month, I have sales of $8,000 times 46.88%, and you get $3,750 in sales for this revenue center for month number 2. Now you can go through the same exercise for cards, paper products, and miscellaneous items for all months and each revenue center. When we look at these sales on a monthly basis, we have total sales for month 1 of $6,000 with a proportionate breakout of where the sales are coming from. That is the revenue centers. Now back to the gross profit analysis worksheet. You see how I have planned for $195,500 in revenue, and these anticipated sales we expect gifts to generate 46.88% or $91,647 in sales, cards to generate 21.88% or $42,775 in sales, paper products to generate 15.62% or $30,539 in sales, and miscellaneous to generate 15.62% or $30,539 in sales. Now for your financial plan. You should break out each of your revenue centers and estimate the sales generated in each revenue center. This is important because we will probably have different costs associated with different revenue centers. We have anticipated sales figures on a monthly basis. We have broken out our sales by revenue center based on the amount of inventory purchased. Now all we have to do is calculate the cost of goods sold. The question that comes to mind is, how do I calculate the cost of goods sold for financial statement purposes? Let's go to our worksheet markup of revenue centers. We have gifts that we paid $1 for. We have decided through market conditions and the area of town that we are located in that 110% markup is competitive in our marketplace for the gifts we are selling. Our markup is $1.10 and our new sales price is $2.10. This is of course the cost plus the markup. That was easy. Now if we are selling something for $2.10 and we have a cost of $1, we get a 48% cost to the dollar of revenue. And here's how you arrive at that percentage. Cost of $1 divided by the sales price of $2.10, which gives you a cost of goods sold as a percent of sales dollar of 48%. The gross profit as a percentage of sales dollar is 100% sales less the cost of goods sold, 48%, gives you a 52% gross profit figure. Our cost of goods sold material is 48% of the revenue center number 1 called gifts. So please multiply the cost percentage of 48% times the revenue within this revenue center. Back to the gross profit analysis worksheet. For instance, $28.13 times my cost of goods sold of 48% gives you a cost figure of $13.50. Then subtract your cost of $13.50 from your sales figure of $28.13, which gives you a gross profit within revenue center number 1 in month 1 of $1,463. Let's go to the next revenue center. We have cards we paid $1 for. We have decided through market conditions in the area of town that we are located in that a lower percent markup is required of 100%. Our markup is $1. Our new sales price is $2. This is of course the cost plus the markup. That was easy. Now, if we sell something for $2 and we have a cost of $1, we get a 50% cost to the dollar of revenue. And here's how we arrive at that percentage. Cost of $1 divided by the sales price of $2, which gives you a cost of goods sold as a percent of sales dollar of 50%. The gross profit as a percent of sales dollar is 100% sales less the cost of goods sold, 50%, gives you a 50% gross profit figure. Our cost of goods sold material is 50% of the Revenue Center number 2 cards. So please multiply the cost percentage of 50% times the revenue within the Revenue Center, for instance, $13.13. The revenue for month 1 times the cost of goods sold of 50% gives you a cost figure of $657. Then subtract your cost of $657 from your sales figure of $13.13, which gives you a gross profit within Revenue Center number 2 in month 1 of $656. You see, the point we are trying to make here is that you need to try and find the multiple revenue centers within your business and track the gross profit within that center. For instance, if I have a division in my accounting firm that only prepares financial statements, I can subtract the salaries from those employees who prepare financial statements to show how much money the company is netting within the revenue center. Another revenue center I may have would be tax planning and preparation. Now back to the company at hand. Our third revenue center here is paper products. As you know, we are a gift store. But that last-minute shopper does not want to go into the grocery store to buy some paper products. So we have a convenience buy for the purchaser. We will take this item that costs us $1 and we will mark it up 200%. The new sales price is $3. We take our sales price and divide it by cost, and we get a 33% cost and a 67% gross profit. This is great. We're going to make a lot of money in this area. However, this is a convenience item and will not generate as high a revenue in this center. Let's go back to the gross profit analysis worksheet. Now, multiply your cost of goods sold of 33% times the revenue of this revenue center, and you will get your material costs. Then subtract the cost from the sales price to arrive at your gross profit amounts. You can see that from the revenue center number 3, paper products, we anticipate sales of $30,539 and a cost of $10,078 and a gross profit of $20,461. When we go through these calculations for revenue center number 4, you will get $30,539 in sales, a cost of $15,273, and a gross profit of $15,266. Now total all the material costs for each of the revenue centers, and you will get total material costs for the year. We get a total of $90,734 in cost to $195,500 in revenue, or an average cost of goods sold of 46.41%. Let's get a little complicated, just a little. I do not want to get bogged down with major calculations, but let's look at how many times our inventory may turn during the year. Assuming we keep our inventory constant, we anticipate the inventory to turn for gifts 2.93 times, which comes from our original investment in gifts of $15,000. Divide $15,000 by our cost of goods sold for the year of $43,992, and you get a turnover of 2.93 times. Cards to turn 3.6 times. Paper products turn 2.02 times with an original investment of $5,000 and a cost of the year of $10,078. And finally, the miscellaneous items to turn 3.05 times per year. The first question that comes to my mind is, why does inventory turn so slowly in the paper products area? It is convenience purchase. The market will not bear a 200% markup on all items. When you divide the total cost of goods sold by the revenue, we get an average of 46.41% of the cost of goods sold. I mentioned earlier that the gross profit percentage was vital. The reason was that we have $100 in sales with a cost of goods sold of 46.41%. If we can improve this percentage by 1 point to 45.41%, we would save on the $195,500 in sales, $1,955, and this would be money in our pocket, and life would be good. However, if we lost through theft or worse, a miscalculation of our markup, say instead of 46.41%, we ran 48.41%, then we would lose out of our pocket $3,910 and life would not be so good. This cost of goods sold is the area that your business can live or die in. A retailer could not mark up his cost correctly and charge too much and not sell enough product, or charge too little and land up giving the product away. A construction company could incur too high a labor cost because of poor planning. A daycare center could have too many employees within certain classes because they are not at capacity. Please, let me again emphasize that you must do physical inventories to be able to calculate your cost of goods sold correctly. For this business, a physical inventory by revenue center inventory type is necessary. Wow, that was a mouthful. We simply must now transfer these totals to the modified cash flow statement and move on to the operating expense area of the financial plan. These operating expenses are easy because they are relatively constant. But first, let's look at the gross profit of some other types of businesses. Let's look at construction. First, a siding company. We only found 2 revenue centers for this company. 80% is for siding and 20% is for painting. So let's look at siding. For every dollar we bring in for the revenue center siding, 37% goes to labor installation and 26% goes to the actual cost of the siding. You then get a gross profit from this revenue center of 37%, or 37 cents of every dollar is gross profit within this revenue center. The second revenue center for the siding construction company is painting. This has a much higher labor cost but a lower material cost. It generates 45% of the dollar to gross profit within this revenue center. For the company as a whole, this siding company has a gross profit of 38.6%. You can see that remodeling generates an overall gross profit figure of 34.05%, and commercial construction generates a 34% to the gross profit line item. When we look at manufacturing furniture, we see a much higher gross profit amount compared to the construction companies. The manufacturing of furniture generates a 46.8% overall gross profit, and manufacturing metal products a 41.5% overall. Do not forget that they have to pay for plant, machinery, and equipment, which is considered an operating expense. So please, let's not all line up and start a cabinet shop. In the service area, you can see we are all in the 40% area, except for hotels and lodging, a business which must pay for its building for a long time, usually 20 to 30 years. Let's look a little bit more closely at the automotive repair company. This company is fun because it's relatively easy to calculate. We have what the mechanics earn for the employer, and they get paid a portion of what they earn, as reflected on the gross profit analysis worksheet. It is 48% of every dollar, and the remainder is gross profit of 52%. The next center is parts, and you can see that the dealers who supply the automotive repair company are still charging the small business owner too much. And finally, there's the expense of subcontracting some of the work to another shop because he does not specialize in the work or do not have the equipment to perform the task, but overall the company generates a gross profit of 46.7%. Most automotive repair shops track the above revenue centers so they can see how much money is generated within each center. Then simply, for financial statement purposes, track the resulting expense for each center. When we look at trade retail, you can see that the convenience store does not make as much money on gasoline as you may have thought it does. As you can see, revenue center number 1, gasoline, has a cost of 87% within this revenue center. Let's get back to the nuts and bolts of our gift store. When we look at the modified cash flow statement, we have our total sales and our costs associated with our total sales. As you can see, the total operating expenses is 52.98% of the sales dollar. When we look at operating expenses as a whole, or we are looking solely at the total operating expenses, the salary and related expenses make up 41.1% of these expenses, the occupancy and related costs of 29.8%, and the debt service of 12.3%. These are pretty large pieces of the pie. Let's go to the operating expense worksheet, page 1 of 3. You may have noticed on the gross profit analysis worksheet, along the left margin, there was a V. This stands for variable costs. As revenue increases, the variable cost material increased. Within all the operating expenses, you will notice that I have defined for you the types of costs in a separate column. There are three types of expenses within the operating expenses. They are variable, which I have previously mentioned vary as the revenue increases or decreases. There are fixed expenses, which are incurred with no relation to the sales figures. And there are discretionary expenses, which usually, but not always, benefit the owner of the business. I have defined these for you for our sample company. When you fill in the blank worksheets, please think about the types of expenses and define the type yourself. When you review the financial plan with your C.P.A., you both can discuss the thought pattern that was involved with the decision. Within the salary and related expenses, you will find line items for salary expense hourly, salary expense salaried, salaried expense owners, bonuses, commissions, temporary help, payroll taxes with a series of percents, health insurance, workers' comp insurance, and employee benefits other. The two main expenses consist of salary for the owner and salary for the hourly people. Salary expense hourly. I have defined this as a variable cost. My rationale was that as the sales increase, the labor cost will increase. However, in this situation, since I can actually eliminate the position, I call it variable. Theoretically, you could be the only worker at the store. Let's look at how the calculation was arrived at to get $953 in the first month and a flat rate of $1906 for the next 11 months. You want another worksheet? Display labor calculation worksheet. The store hours from 10 a.m. to 7:30 p.m. The store manager will work Monday through Friday from 10 a.m. to 6:30 p.m. and that person is allowed 30 minutes for lunch, 8 hours per day at a rate of $7.50 per hour, or $60 per day, or $300 per week. We will also require a part-time employee. This person will work from 4 p.m. to 7:30 p.m. Perhaps a student would like these hours. That person must be relatively responsible because they will probably be closing the store. You can see on the schedule that the person will work 3.5 hours per day, Monday through Friday, and on Saturday they will work for 8 hours with a half hour for lunch, or a total of 25.5 hours for the week. This person will be paid at a rate of $5.50 per hour, or $140.25 per week. Your total weekly payroll will be $300 plus $140.25, or $440.25 per week. Now let's go to the calendar. The objective of all employers is to sit on cash flow. In this situation, we will hold back payroll earned from our employees. I am not cruel, but I want your business to survive. We pay for the 1st through the 15th, paid on the 20th. The 16th through the 31st is paid on the 5th. This gives you time to calculate the payroll and allows you to pick up a few days of cash flow. This is a bi-monthly payroll. This company pays 24 times per year. Other ways to pay would be bi-weekly, weekly, or monthly. Since we have a bi-monthly payroll, we have 52 weeks in the year divided by 12 months in the year, or we will pay, on the average, 4.33 weeks for each month of payroll. With a weekly payroll of $440.25 times 4.33 weeks, we get $1906.28 per month in payroll hourly expense. Now, since we sit on the paycheck for 5 days, we will not pay for the last half of the month until the 5th of the following month. As you can see from our example, the 5th is on a Sunday. Therefore, we back up the payday in this example and pay it on Saturday. The second month of our operation, we will certainly have 2 paychecks in our example, with paydays for the next month on the 4th and the 20th. So simply fill in the blanks of 1 pay period for the first month and 2 pay periods thereafter. The next line item is salary expense salaried. I love this line item. Give the person a salary, a few people to manage, and work them greater than 40 hours per week. There are requirements for a salaried person. Be careful. The Department of Labor will have a chat with you concerning overtime, so be careful. But generally, you need a salaried person to earn their salary. They are either great workers or they put in the hours necessary to get the job done. Or if you're lucky, they do both. The next line item, salaried expense owners. You have budgeted for yourself that you can survive 5 months without direct compensation. The 6th month you have decided you need $1,000, the 7th $1,500, and thereafter $2,000 is reasonable. Sorry, owners, the rent must be paid before you get paid. Therefore, I consider this cost a discretionary one. The next line item are bonuses. This is certainly a discretionary cost. It may be paid to you, but I hope by this time you are pleased with the manager and you give him a $50 bonus the 5th month of the business operation. The 12th month, I must really fork over the extra effort that person has done for me, and we have budgeted $500. Commissions, a variable cost, and we are not paying commissions on this retail store. After all, the employees were hired to sell, and sell they must. Other businesses have commissioned people. These businesses get paid on a percent of what they do or what they sell. For instance, for this retail store, perhaps 1% of the sales commission expense over a certain dollar amount sold. This would be a lot like what we did not want to get involved with the rent override. My favorite area, payroll taxes. Look at that. We have Social Security at 6.2%. We have Medicaid at 1.45%. We have, in Georgia, state unemployment at 2.7%, and federal unemployment at 0.08%. Wow. This is calculated against, of course, the payroll dollar. The payroll dollar consists of all the items we previously went over. Let's look and see what payroll taxes are computed on: salary expense hourly, salary expense salaried, salary expense owners, bonuses, commissions, and temporary help. I guess we are relatively lucky in that we do not have to calculate the payroll taxes on the labor cost in the cost of goods sold area. You see how there's no labor cost in this cost of goods sold area. Health insurance. For this company is a discretionary expense, and for $200 per month, it really only covers the owner. But if you need health insurance, you must pay for it. Now, if you are going to offer health insurance to your employees, speak to your C.P.A. regarding the deductibility of the item. If you choose to offer health insurance to your employees, you may want to mention to your insurance agent the cafeteria plan. You would take the gross payroll, subtract the health insurance paid by the employer, and then calculate the payroll taxes. This is, of course, a good idea to save on payroll taxes in that if you paid on an employee's behalf $2,000 in insurance premiums during the year, the total payroll taxes of Social Security, Medicaid, state and federal unemployment, or 11.15%, times the insurance paid of $2,000, you would save $223. It is not a great savings, but you need to save wherever you can, and this is on a per-employee basis. So if you have 10 employees, you could possibly save on an annual basis $2,223. More insurance, this time workers' compensation. For a retail store, just multiply your payroll expense times the applicable rate. In this case, it is about 1%. You see that the total for the year is $350, so you may want to pay this in a few payments instead of a monthly payment. Workers' compensation insurance, believe it or not, helps the employer. It limits an injured employee to only receive so much if that person is injured on the job. They even have a value of 1 knuckle on a specific finger of your left hand. Of course, we have the people who abuse the system. In the construction business, it is not unusual for a company to pay 17% for some classes of workers. Make sure that when you have your annual workers' comp audit, you correctly classify your payroll dollar, and do not forget to back out the overtime pay. I certainly recommend that you have this type of insurance. You may not be required to carry the insurance by law. There is a number of employee limit on whether it is required to be carried. Also, corporate officers may be eliminated from the coverage. Please consult your C.P.A. who knows the rules, then your insurance agent. Do not forget that your insurance agent is in the business of selling insurance, so make sure you know what you want before you make the purchase. If the owner of the corporation has a disability policy, then he may not need workers' compensation insurance for himself. The reason you may want a disability policy is that the workers' compensation insurance pays very little if you're permanently disabled. Finally, other benefits. I don't know what miscellaneous items you want deducted from the corporation, what miscellaneous items you will provide your employees, but it has been my experience that you will spend something. It is a discretionary expense, and we listed $25 per month. An example may be bottled water for your employees. Of the total operating expenses of $103,573, we have accounted for $42,584 of this amount, or 41.1% of the dollar. Let's go back and scan the types of expenses. Only one fixed expense, which is for salaried employees, which does not apply in this example. There are discretionary expenses such as owner's compensation, bonuses, health insurance, and other benefits, and the rest are variable as they relate to the volume of sales. You can see on the pie chart that the majority of the costs are for your employees within this category, with 51.8% of these costs applying to hourly employees. The next largest slice of the pie is the compensation to the owners at 29.6%, and look at those payroll taxes at 9.4% of the salary and related expenses. The next area of costs are the supply and related expenses. You can see that of the sales dollar, only 1.96% applies to supplies, or with the operating expenses, supplies are only 3.7% of the total operating expenses. You can see from the total operating expenses of $103,573, only $3,838 is supplies, or 3%. If you watch your pennies, the dollars will take care of themselves. You can see this area does not have any discretionary expenses. Two types are fixed and the remainder are variable. So let's begin. Postage. As you can see, as your volume increases, you use more stamps. Office supplies. Now be smart, decide what you really need, and do not fill your office supply drawer with unnecessary items. You will note in the first month, we need to make the initial purchase of $150. Thereafter, we calculate 1/3 of a percentage point to total sales. The initial purchase makes the total office supplies for this area 0.37% of the sales dollar for the year. Repairs and maintenance. You may have to repair a cash register. The windows may need cleaning, so budget something for the unexpected as well as the recurring needs. We calculated 1/4 of a point to the sales dollar, or $489 for the year. Not a lot, but we have addressed the point. Those of you who have maintenance contracts on your equipment, you may want to isolate the contracts individually and call them fixed costs. Speaking of fixed costs, we must lease a credit card approval machine, and the lease payment is $25 per month. And we fill in the fixed cost across the board. The next area is delivery expense, a variable cost that you can control. You will either pay an employee mileage at an agreed upon rate per mile, or you will reimburse him for actual expenses incurred, or you may even use a courier service. For this company, we used a variable rate of 0.15 of a percentage point of the total sales dollar. Now let's go back to the standard mileage rate. The government allows, for tax purposes, for you to deduct 27.5 cents per mile in 1992. I have some clients that pay 11 cents per mile to employees. Just put a policy in place when you start your business and be consistent thereafter. Non-capital equipment. I'm not sure what you'll need. A non-capital piece of equipment is something that has a useful life of greater than a year, but has such a low dollar cost amount that it is not worth the trouble to capitalize the asset and depreciate it over its estimated useful life. Some companies have a dollar figure of $50 to $1,000. For this business, we will have a capital limit of $250. As the model indicates, you can see that we have budgeted $489 for the year, or 0.25% of gross sales. An example of an asset with a useful life of greater than a year and a cost of less than $250 would be a calculator with a cost of $89. This business will not use any consumable supplies, so we have not budgeted any amount for this cost center. All of our supplies are captured under office supplies. We have another fixed cost, bank charges. whereby we will be assessed a monthly fee of $15. Simply take this fee and fill in the fixed cost across the board. The credit card discount fee. We anticipate 20% of our sales to be paid for with a credit card. The remainder will be paid for with personal checks and cash. We estimate that our fee for from these credit card companies will be 2.5%. So we take our estimated credit card sales times the 2.5%. Sorry, no worksheet necessary. We have now completed the supply and related expenses, where a majority of our costs are variable in nature. Let's move to travel, entertainment, and auto area. As you can see, the majority of these costs are discretionary. For this business, they are designed for items that are tax deductible if the proper documentation is obtained by the company. We are not looking for trouble from the IRS, but you should certainly have some benefits from your venture. Consult your C.P.A. and he will assist you in the deductibility of the item and the documentation required. Travel. Put in a budget amount that fits your lifestyle. For this company, $50 per month. Entertainment, let's go with $30 per month. Food, let's go with $30 per month. The rationale for breaking out food costs on a separate line item is that only 80% of the line item is deductible for income tax purposes. Therefore, we have an easy line item to pick up when your taxes are prepared. More discretionary costs are the auto and truck area. This employee stockholder has an auto payment in the amount of $212 per month. He pays $60 per month for insurance. Now we have the only variable cost in the area because as the business increases, you are driving more places for work. This line item has been reserved for the owner of the company. Any other delivery costs are in the delivery expense center, and we are paying our employees probably 11 cents per mile to run around for us. We estimate that 0.3% of the sales dollar will go to gasoline. Now, do not forget that the government allows us to pay yourself 27.5 cents per mile. If the mileage rate is higher than the actual expenses, then I guess you better deduct the mileage rate allowance. These costs, mileage, auto, and entertainment for this company are really discretionary. You need to try and deduct everything in sight, or we will end up paying more taxes than necessary. Please consult your C.P.A. concerning the above items. You can see on this pie chart that I have only one variable expense, gasoline, and the remainder are discretionary. The service area. Legal. Those legal eagles are hitting us again, this time for only $650 for the incorporation fee. I guess we got off lucky. They will be around next year to update our corporate minute book. This update of the corporate minute book approves salaries and certain action taken by the corporation and documents what has transpired and what will transpire in the coming year. Most CPAs can assist you in the update of your corporate minute books. Also, if anybody really knows what's going on, it is your CPA. Accounting. A certified public accountant. Have I mentioned CPA before? This is, in my opinion, the best way to go. $125 per month is reasonable fee for this business. It is always best to invest your money in a person that is qualified by the Secretary of State to deal with financial matters. Other services, a variable cost. For this plan, we calculated 0.3% of the sales dollar. Somebody will eat this up, from computer support to a special project for your lawyer to your CPA. But let's budget something for this area. Advertising and promotions. If you are a new business, you better let as many people as possible know you are there and what you are doing. I consider these fixed costs, so please spend the money. As you can see, we will use print advertising, probably in a neighbor newspaper. We have budgeted, and we will spend $50 per month. I am a CPA, but I'm also a coupon man. You know, the frugal accountant. As a new business, we hit it heavy the first month we opened with 2 mailers. The second month, only 1 mailer, then 1 month off. For the rest of the year, it is 1 coupon for 2 months, then a month off. Other advertising. I'm not sure, but you'll find something to try, so let's budget $50 a month for the year. Promotions. As you can see, we hit it hard in the first month and again in the second and third months. Then we took it easy until the 9th month, then hit it again the 12th. Now that's not too bad. Just under 3% of our total revenue dollar goes to advertising. but you must track your sales. You must know where your business is coming from. I recommend that you list on the internal copies of your invoices where the business came from. This way, next year, you will be able to know where to concentrate your budgeted advertising dollar. Some codes we have used in the past are W for walk-in, E for existing customers, R referral, P print advertising, C coupons, PR promotions, Y yellow pages. No big deal, just whatever works for you. Please track your revenue. You need to know what works. The only way you're going to know what works is to track it numerically. Most of my new business clients have a visceral feel for what works in advertising. Now I've trained them to track their revenue at the source, track the revenue at the point of sale. Maybe all your business is walk-in and you don't need any advertising. Let's be smart. After all, you are planning on spending $5,550 for advertising this year. Advertising is a fixed cost, so continue to advertise until you find out what is effective for your business. Be smart, and I repeat, track your revenue at the point of sale. Here we are again, another major area of operating expenses, occupancy and related costs. You can see that this area takes up 15.81% of our sales dollar. You can see that this area takes up 29.84% of our operating expenses. Here's our pie of occupancy and related costs. Wow, look at that rent expense. Let's go back to our worksheets. These types of expenses in this area are generally fixed. Telephone is a fixed cost for 2 lines and 3 listings in the yellow pages with a cost of $165 per month. Fill it in across the board. Utilities. The landlord told us the power bill runs about $200 per month. However, before I signed the lease, I contacted various other shops and they told me that the bills run about $250 per month for approximately the same square footage. We'll run with $250 per month. Insurance. More insurance. Most lessors require general liability insurance upon the signing of the lease. You can plan to pay in insurance, health, workers' compensation, perhaps a disability policy, and now general liability. This general liability policy is budgeted at a cost of $50 per month. Property taxes are an assessment on the value of the inventory and equipment purchased. Contact the county or city where your business is located and ask them for the assessment percentage on the dollar values. We pay payroll taxes, sales taxes, real property taxes when we pay our rent. It is probably included in the rent payment. Taxes on our phone bill, taxes on our utilities, income taxes federal, income taxes state, income taxes local, gasoline taxes when we purchase our fuel, and now we pay property taxes on what we own. Did we not pay for the taxes when we purchased the asset originally? Now taxes again. We calculated it to be $641 for the year and paid about the 11th month of the business year. Rent. After your lease negotiations, you pay a flat $2,000 per month for the year. Business license fee. $200 when you open the doors and every year thereafter. Usually when you see the word fee, it may be another word for tax. Depreciation. Talk to your C.P.A. You may find that the government is a little helpful in this area. You may ask your C.P.A. about the accelerated write-off of the Section 179 deduction. Now miscellaneous. I'm not sure how anybody can have a miscellaneous account after all the accounts we went over. But why not budget yourself 1/4 percentage point of the sales dollar and go to a movie, buy some popcorn, and think about how you're going to pay all those taxes. More fixed costs, debt service, and the final area of our operating expenses. I know you need $40,750 from the initial cash outlay worksheet. And as a C.P.A., I took a little shortcut and figured that the total debt service required is $50,000. You can see that the debt summary is for $50,000 payable over 5 years at 10% interest, which will give us a payment amount of $1,065 per month. You see that the interest payment changes monthly and the principal payment changes monthly. But the total payment amount is the same. This is one of the differences that makes this a cash flow statement. You cannot deduct for financial statement purposes the principal portion of the debt. The source of this debt may be varied. With a corporation, you can lend the company money, or the funds can be acquired from lending institutions. Please note again that you have a constant payment amount of $1065 with the interest and principal broken out on a monthly basis. Before we fill in the numbers on the modified cash flow statement, let's analyze the types of operating expenses that we have covered. You have fixed cost of $51,381. You have variable costs within the operating expenses of $31,858 and discretionary costs of $20,334. These fixed costs you will spend whether you sell the first widget or not. You see the fixed costs in the red remain relatively constant throughout the year. The discretionary cost increases as your business becomes more profitable. Your variable expenses do not increase as much as you would think in the operating expense area. But remember, variable costs of the cost of goods sold are not included here. When I show the variable expenses with the cost of goods sold material, you get the full flavor of the variable expenses. Now you would fill in your totals on the modified cash flow statement as I have done for you. Now for the first month of the operation, you will generate a loss of $4,644. This money has to come from somewhere, so fill in the first month loss in the total cash requirements worksheet. You can see you will lose money in the second month, third month, fourth months. Let's fill in the operating losses in the total cash required worksheet. And we get the total cash required of $50,290. Now, what a surprise. Month 5, with sales of $13,500, you break even without any direct compensation to you. The objective is to have sales in month 8. With $20,000 in sales per month, you then pay yourself $2,000 and you still net $1,131 after debt service. But now let's look at year end. The total net profit for the year is $1,193. Well, at least we're in the black. In the black means you made money. What do you do with this money? Any extra money you can pay yourself, or you can pay down your debt service more quickly. Warning, watch your inventory level. If you increase your inventory, say $20,000 during the year, where's this money coming from? If you simply replace the inventory you sold, you should not have more than $90,734 in purchases. Now, let's take a final look at our total cash requirements pie chart. As you can see, the final 19% of the graph is the extra cash needed for the $9,540 in operating losses in months 1 through 4. Let's look at another chart that shows you total revenue by month and look and see how the total cost of goods sold increases and decreases in direct relation to the revenue. You can see that fixed costs remain relatively constant throughout the year. The variable costs within the operating expenses vary slightly. The discretionary costs increases as sales increases because you are profitable and smart in that you have documented otherwise non-deductible items. And finally, net income or loss generating losses in months 1 through 4. Month 5 you break even, and month 6 and forever after you are in the black. Back to the sample companies. Since you know the gross profit percentage, you can take any operating expenses, divide it by our gross profit percentage, and get the total revenue dollar needed to break even. For a construction company in the siding business, we have a break-even point on operating expenses of $103,573 of $268,324. This is simply the $103,573 operating expenses divided by the gross profit percentage of 38.6%, which gives you a break-even point of $268,324. In the service area, we have a child care center with a break-even point of $235,393. Let's look at hotels and lodging. We have a very low break-even point of $136,280. But remember, with operating expenses including debt service, the amount seems very low. In the trade retail, we have our gift and novelty store. This, of course, is the company we prepared the financial plan for. Our break-even point is $193,269, and as you are aware, we had sales in the plan of $195,500, generating profits of $1,193 for the year. So you know, when you get the gross profit percentage, you can divide this percentage into annual sales projections, a monthly sales projection, or you could even break it down to weekly or daily to get the all-important break-even calculation. Congratulations. I hope you have learned something. The next time you go to the gift store, maybe you will admire that person for going for it all and won't squawk when you have to pay $3 for those paper plates instead of the $2.20 the grocery store charges. Please remember, 2/3 of the American people are employed by small businesses. Your dream may not be as far away as you may think. Thank you.